Let's get straight into a look at what's been playing out in the US. Of course, all the euphoria over the election campaign now having come to an end, and it's worries over the risk of a recession in the US that seem to be assuming center stage at this stage of the game. Your views on what's taken a hold of markets post those election results?
Well, hi, Alishia. I think markets suffer from an acute sense of attention deficit disorder at the moment. The market seems just to be able to focus on one thing at a time. So back in September, there was a lot of near-term euphoria around QE, and every strategist note that came out was bullish on the market. And now all of a sudden, post the election, everyone's worried about the fiscal cliff. The reality is that QE was quite well signposted ahead of the game by Bernanke's speeches, and the fiscal cliff issue we've known has been a risk for several months, but it's only now that the market started to focus on the fiscal cliff, now that we've got through the election.
Tristan, it's Lindsay in Cape Town. The reality is, of course, that the market just needs constantly to be fed. It's a living, breathing entity. It's an organism almost. And now that the election's out the way, and there was nothing particularly, I mean, it was quite exciting and everything, but now the market's, as it is, ADD's got to focus on something else. QE3 has had less effect than QE1 and QE2. And let's not forget, it's about the earnings, and earnings haven't been brilliant in the third quarter. So I would have thought it's absolutely natural for the market to say, you know what, we're waiting for the next big thing before we start buying again.
Yeah, I think that's right. I mean, as I say, market participants got quite carried away in September. Our view is that equities are the preferred asset class over the medium term, but that tells you very little about the short term. And we sense that there were risks in terms of earnings season, and it hasn't been a particularly brilliant earnings season. We know the global economy is in quite a tricky spot. The US is chugging along, but overall global growth is quite mediocre at the moment. And technically markets haven't looked great, which has been a consideration. So we've been more or less standing by the sidelines for a couple of months, actually, because our view has been that sometimes there are good times to take big positions and have a lot of risk on board, and other times it pays to be more patient and stand back, and that's been our position for a couple of months now.
Tristan, to what extent are you prompting investors to take some risk off the table at this point?
Well, I wouldn't go as far as to say that, because as I say, our medium-term view is that equities will do well. Now, I think we are in a period now over the coming months where we'll see quite a lot of uncertainty over the fiscal cliff. We'll get a lot of noise in the data related to Hurricane Sandy as well, so that'll only confuse matters, although it won't change anything about the trend of the economy. And it's very difficult to see just how those negotiations will go with regards to the fiscal cliff, although the base case scenario would be that some kind of deal can be struck, even if it's at the last minute, because that would be the most logical and sensible outcome.
Do you think that as equities are your preferred asset class, Tristan, that you should be sticking to the United States of America and some of the other developed countries, dare I say it, even Europe, or can you be more geographically specific about what you like? I mean, dare I say it as well, that we should start looking at emerging markets again, given the numbers coming out of China this morning?
Yeah, I think the data out of China is quite encouraging actually this morning. Inflation down at 1.7, that's quite good news, and the activity numbers surprisingly on the upside. So as things stand currently, we're actually overweight emerging market equities, focused specifically on Asia, in particular China and India. Over the course of the last couple of months, we upped Europe to a neutral position. We had been cautious previously, but we think policy action has been quite important there, so we've upped Europe to neutral, and that actually leaves us slightly underweight the US, which is a surprise in some sense, in that the US economy has been doing better than many others, but then the US market has outperformed a lot in recent times, and it is more expensively valued than other markets, although I wouldn't go as far as to say it's overvalued.
You've given us a sense of your exposure on a geographic basis, Tristan. If we get a little bit more specific than that, where exactly are you seeing the value? And let's perhaps start off in that Asian territory specifically. Where are you seeing the opportunities for investment specifically on a sector basis?
Well, I think what we're trying to do, especially in Asia, is to pick what we think are high quality companies. So to take a longer term approach and look to the managements that we like, high quality franchises. We also, on a global basis, look for stocks that we think can pay a sustainable dividend. So those companies that are not too leveraged, that don't have a lot of earnings risk. And yet have a decent yield, maybe in the 3, 4, 5% type of range. And then on a global basis, a theme we continue to like is the death of cheap oil supply. That's the theme that we call it. And the argument there is to look for companies that are going to benefit from the move to source oil from more difficult places in the world, so deep offshore wells off the coast of Brazil or Africa, for example. A lot of those companies are found in places such as Norway.
So it's exploration companies you're really looking for. You wouldn't, for example, look at a company like Sasol, which has always been at the forefront of new technology, gas to liquids, coal to liquids, etc. It's rather the exploration side. You see the chase for oil and new oil reserves, and you think laterally.
Well, that's right. I mean, the Ashburton funds run out of Jersey. Are offshore funds from a South African perspective, so we don't in these funds invest directly in South Africa. But that's right. I mean, not that many. It's not. Maybe Europe might not be an obvious place to look for oil companies, but certainly in the European fund that my colleagues manage, oil has been a big theme. In particular, these Norwegian oil services, engineering, exploration companies, which are the leaders in their field.
How does Africa fit into that equation? We've recently had big gas and oil discoveries off the east coast of Africa, and many, rushing in to leverage off those new finds.
Yeah, I think that's right. I think it's going to be an increasing theme. You can argue there's plenty of oil in the world, but it's increasingly not coming from the traditional sources that are quite cheap. And they're coming from these more expensive areas to source the oil. And that includes shale oil in the US, which still requires quite a high oil price to be economic. And therefore, we think you don't necessarily want to be invested in the companies spending a lot of capex. It's quite expensive to exploit these reserves, but rather on the beneficiaries of that corporate spending from the majors.
Going back to what you said about the characteristics of the companies that you like, and you talked about, essentially you want a blue chip company. It's got to be well diversified with some good franchises, presumably well geographically diversified as well between the developed world and emerging markets. It's got to have great management. It's got to have a strong balance sheet. It's got to have a good, strong cash flow. It's got to be a dividend payer. That seems to have been a theme, Tristan, that's been put forward for many years now. And I just wondered if the valuations of such companies, which do exist of course, are becoming a little bit stretched and the actual trade itself is becoming a little bit crowded.
Yeah, I think that's certainly a concern, because you can argue that's quite a consensus view to have. And you have to think under what circumstances that strategy is not going to be the best one. And I think the circumstances when that strategy might not work would be if the global economy is suddenly doing a lot better. We see a strong cyclical pickup in China, fiscal cliff avoided, and Mario Draghi solved all of Europe's problems, and Europe starts to enter a growth phase with fewer concerns over the sovereign debt crisis and banking crisis in Europe. Now, that clearly is one possibility. However, that requires an awful lot of things to go right with nothing going wrong in the interim. And therefore, I think on a risk-reward basis, looking for the high-quality companies with sustainable dividends, I think makes sense in this current difficult economic environment. You may want to have a bit of cyclical risk on the side if one is feeling a bit more bullish. But I think we still live in difficult times, and it makes sense to look for these high-quality companies.
Just how much cyclical risk at this stage, Tristan, are you exposed to?
We're not. I mean, we're quite cautious at the moment in our allocations, and I say we have been for a short while. Now, it may be the case that if equity markets come off over the next month or so, if we're back to levels that we saw in the summer, I think for global markets that would start to look quite an attractive proposition, because things in China are picking up and are not as bad as some of the worst fears in the summer, and the European policy response has also been positive since that point in time.
Finally, Tristan, what's happened in the last couple of days, notably in the United States of America, where you say you're underweight equities, i.e. a 2.5% fall on the market the day after the election, and also near 1% fall on the Dow Jones last night. Bit of selling coming into Europe. Technically, things not looking so fantastic on the graphs, but you probably don't look at those, but a lot of people do. Do you think this is the start of something? Do you think 2013 might be unlucky for some?
Well, we'll have to see how things pan out. I mean, we do take notice of charts because a lot of other people do, and therefore you have to be aware of them. So we're not putting risk to work just yet in terms of this correction that we've seen. But we'll have to see how matters resolve themselves, I think, particularly with regard to the fiscal cliff. And if the worst case outcomes can be avoided, then I think actually there are prospects of a cyclical pickup in global growth as we go through 2013, led by emerging markets principally. So I think we'll stick to current strategy for the time being, tread a cautious path. But as things progress, we may look to be more aggressive if markets come down or if some of these concerns abate.